All right, let's continue the U.S.-China trade conversation and talk about the impact we're seeing on markets. Joining us now live from Delaware is Eddie Ghabour, co-founding manager partner at Key Advisors Group. Eddie, thanks for coming on. What's your take on what happened yesterday? I mean, the way that we closed yesterday, and now right now we are seeing green for now.
Yeah, I think this volatility that we've been experiencing the month of August is here to stay here in the short term. I mean, right now, the bond market is sending off a warning signal for investors. I've been very bullish the last 4 years, and nationally, I've not been afraid to tell about how bullish I am. But right now, I think investors need to read what the bond market is saying and be a little bit more cautious. Look at days when the market is strong to possibly raise cash. If you're too overweight equities, start playing some defense, because I think we're going to have a very rocky road here for the next couple of months. We've got the geopolitical issues with China and the trade war, and we've got the inversion of the yield curve that's spooking investors. And until the bond market calms down and shows a bottom, I think you're going to see volatility continue to go through the roof. And our concern is for investors out there that haven't taken profits over the fantastic growth they've had, they may see a whipsaw like we saw in the fourth quarter. We want investors to be able to take advantage of that, because when it happens, we want to be able to pounce. And the only way you can do that is if you have cash on the sidelines.
So many analysts view Apple as the poster child for the trade war. What do you tell investors in terms of investing in tech during this time period?
You know, I think right now, technology, you have to be very cautious on it. Again, they've had a fantastic run up. And until we see the rhetoric change between China and the U.S., I think you're holding yourself out there too much from a risk perspective. Everyone's risk tolerance is different, of course. I just worry about investors that haven't rebalanced portfolios, and now they're overweight tech, they're overweight semis, and those are areas that could get hit quite a bit if the rhetoric continues to accelerate. Because right now, it doesn't look like the U.S. or China is willing to bend or blink at this point in time.
Hey, Eddie, Brian Chung here. So as we know, the yield curve is not a reason why we get a recession. It just shows that people are concerned that there's another trigger that would need to be in place for the actual recession to begin. What is that thing for you? What are you kind of closely watching to see? Are there any sort of bubbles that you worry would be the nexus for whatever it happens, if it happens in the next 8 months or 2 years or so?
You know, one thing that does concern me is the amount of corporate debt that's out there, okay? And so I think when you're looking at companies that are over-leveraged, those are the ones that concern us the most. That's why when we talk about playing defense, it's not only cash, but equities you decide to buy is really paying attention to the balance sheets of these companies. As you well know, when economies are booming, debt and leverage is good, but when there's a slowdown, companies that are over-leveraged are going to have a tremendous amount of financial strain. And we want to be able, again, as investors, to have some safety on the sidelines, so that way when we have these big corrections, like we saw in the fourth quarter, we can actually take advantage of it.
Eddie, we're talking about the yield curve briefly inverting yesterday and sort of all of the concerns that prompted. What do you make of this impact now on the Fed? What do you expect from the Fed in the rest of 2019? And does what happened yesterday affect what the Fed might do next?
I think we can expect another 50 basis point cut between now and the end of the year with the Fed. If you would have asked me 6 months ago, I would have said no. But considering what's happening on the yield curve and the pressure they're going to get from the markets, I think right now the market is fully pricing in a Fed cut in September. And if they don't deliver, you're going to see a substantial sell-off, in my opinion. And I think they are listening to markets. The yield curve absolutely concerns them. The other thing is the global economy is slowing down. The one thing that's keeping the U.S. healthy is the consumer. We have a very, very strong consumer. If it was not for the consumer, we would be in trouble as well, too. So the globe around us is slowing down, and the Fed has to get ahead of it and be proactive and cut rates instead of being reactive and waiting until our data starts to weaken.
All right, that is Eddie Ghabour on markets. Thanks so much for joining us. Good chat.
Thank you for having me.